the good, the bad, and the ugly on today's uncertain markets. Well, today we've got a really special treat for you guys. On Saturday, September 13th, I was at the Metro Toronto Convention Center and I delivered a 45-minute talk on both the bull side and the bear case for today's markets. Through the seminar, I covered tons and tons of charts, and near the end, I even answered questions from viewers like you. In fact, many of the members of the audience, which numbered over 160 people, I was told, were people from my YouTube and blog audience. So thanks, guys, for showing up. And at the very end of today's video, I want you to stick around because I presented the audience with a 30% coupon for my online trading course, and you guys will get that code if you watch the video near the end. I present it. My name is Keith Richards. I'm President and Chief Portfolio Manager of Value Trend Wealth Management, and this is Smart Money, Dumb Money. Thanks for being here, and remember, you're smart money. Different format this year for me because they usually, I'm in the bigger one and there's two screens and the guy tells you who I am, but for those who don't know who I am. My name is Keith Richards. I'm not the guy from the Rolling Stones, so those fanboys might as well go home because I'm not that guy. So I'm a technical analyst, been around for too long, 35 years, 36 years now. In the business, portfolio manager. I don't know, what else do you need to know? I'm on BNN, I write a lot, I've written books and whatever. So that's me. So we're here to talk about the market. And I was just thinking, because I mentioned BNN, I've been on BNN. They did a 25th anniversary for the BNN show just a couple of years ago. I don't know if anybody was aware of that. So it was kind of cool because they showed an image of me when I had hair and a mustache because I've been on BNN for 25 years. And I think I've been doing the Money Saver, or Money Show, I should say, for about 20. I'm not sure of that because I am getting old and I don't remember everything anymore. But I do kind of remember my first Money Show because I was in front of a crowd like you guys. And I was kind of scared, and then I did my talk and it worked out okay, and I guess at that point I was hooked. But nowadays they don't hook you, they just ask you to leave. But anyways, so that's the only joke that I'm going to tell. So we're going to talk about the market. I've got like 40 minutes. There's only so much I can talk about in 40 minutes. So what I did was sort of selectively choose things to talk about. Any of you guys read my blogs or watch my videos? Yeah, okay, yes, a lot. Okay, good. So a lot of this stuff is just skimming the top today. If you want more information, I'm fairly prolific with my writings and my, other media stuff. The one thing you'll notice is if you go on my YouTube, I don't do commercials. Or if you go on my blog, there's no commercials because I'm not doing that for money. I'm doing it because I've been in the business a long time, and I was just talking to Fabian, I'm kind of now at this point of my life that I feel I should have some sort of a pass it on kind of attitude. So that's what I'm trying to do. So we're going to just skim through a few things. As you can see here, fundamentals, technicals, this is not the order I'm presenting them in. Breadth, seasonal, sentiment. I'll describe what these things are as I talk about them, and then how we are positioned, okay? Again, I got 40 minutes, and then I'm going to try to answer your questions. So we're going to squish a lot in. So this is skimming, but hopefully it'll help. Okay, so we're going to start off. The market's kind of a funny thing, right? In case nobody noticed, it's not about trends. It's not about value. It's not about growth. It's not about anything. It's about everything. And so that is to me, I had a guy that actually worked for me, and he came out of veterinary medicine, and he said he went back to veterinary medicine because he said, veterinary medicine, you see the patient's symptoms, you follow a pathway, and you have a pretty good chance of being right. with this, you look at evidence, like we're going to talk about today, and you still could be dead wrong, okay? So one of the things I've learned in 35 years of trading is have humility. And if there's one thing that actually I never, ever tolerate is when people make flat assertions. And I don't make flat assertions myself. So if you're going to come here today and ask me, where's the market going? The answer is, I'm just going to give you the odds of the risk versus reward odds. But at the end of the day, the market's going to do what the market's going to do. Okay? So here's some evidence. It's just one factor. We look at Value Trend, we look at a number of different factors. We're going to skim like one or two out of each factor. I have a CFA that works for me, Craig Aucoin. He's a VP at Value Trend. He's a CFA. He does all that fundamental stuff. So this is a simple chart, the PE ratio. You guys have seen it a million times. The PE ratio is like the 4th highest in history. In fact, if you look at the cyclically adjusted PE ratio, which is adjusted for inflation, it's the 3rd highest in all of history, okay, for the S&P. So that means it's expensive. Does that mean the market's going to crash? No. But it means that there's a higher risk than if it was, say, down near 10, right? I mean, that's logical, right? So we're just going to look at factors, and we're just looking at risk. So the next risk thing from a fundamental point of view, and I'm just skimming here, okay, is the S&P dividend yield. We're going back to like 1980 there, and the S&P dividend yield is about as low as it's ever been. So that means that people used to buy stocks to get dividends, you know. There ain't so much dividend going on. It's less than 1% for the average, for the S&P 500. So that may indicate that, I mean, it's all been about growth and NVIDIA and all that stuff, but, you know, it's also an historic anomaly. So I just point that out without making assertions as to what's going to happen, but it's something we need to know, okay? From a economic point of view, expected changes in business conditions, and when you're University of Michigan does like 8 million studies, you can get them for free. Just type in University of Michigan consumer sentiment surveys and stuff, and you can see the businesses are expecting lousy conditions. The gray here, these are, you'll see these gray bars on some of my charts. They're recessions, okay? So obviously, when businesses are kind of bearish, businesses themselves, it tends to lead into recession. And there is also a tie-in where recessions can be coincidental, not leading, but coincidental with market pullbacks, okay? So it's important to know that businesses are not all that happy right now. That chart was from Rosenberg. So I'm just skimming stuff, but the next thing I want to talk about is market breadth. Does anybody know what the word breadth means with a D, B-R-E-A-D? You guys kind of have an idea? So market breadth means that if you took 500 stocks in the S&P, it's actually 504 or something like that, but if you took 500 stocks in the S&P and 10 of them were going up and 490 were going down, that would mean you have really bad diversity amongst the S&P 500, right? A healthy market, Bob Farrell once said that poor breadth is a sign of a weak market, okay? So when you've got just a few stocks doing all the lifting, that's a problem, and that's been the situation now. One way, one of many, many, many ways I look at breadth, and I've got like 10 indicators I look at, but this is one of them that's kind of interesting. It's been around for like 100 years, Charles Dow. He said that the industrials and transports must confirm each other, and yes, industrials aren't what they used to be. Microsoft is one of the industrials now. So, but they must confirm each other, okay? So it's rare that you see the two move separately. So I want to show you something here, and that is that normally, I mean, you know, it's not perfect, but this one makes a peak. The red line is the industrials, the black line is transports. You know, if they go one up together, they're going down together. They don't have to move side by side. But here we have, and if you guys read my blog, you'll notice I sometimes call this the jaws. You ever heard me say that? This is the jaws. So it's like an alligator, right? So there's the jaws of the alligator. The industrials are going up, transports are going down. That's called inversion of the norm. We have a discrepancy between industrials and transports, okay? Now, you could argue that's an old theory and transports aren't as important, blah, blah, blah. But funny enough, I've been following this literally since I first started studying technical analysis in the late 90s. And I will tell you that when this sucker does that, it usually leads into some sort of a correction. I mean, I almost never seen it not. Is that a right way? Never not? That's double negative. But anyways, it's a telling sign. And so I'm seeing that's a problem in breadth. Okay, here's another problem in breadth that would make maybe a little bit more logical sense. This is the New York Stock Exchange composite. So it's an index. It's not the S&P, it's not the NASDAQ, it's not the Dow. It's the New York Stock Exchange composite. I think it's made up of about 1,800 stocks. You can correct me if I'm wrong, but it's way more than 500 stocks. And what this is showing you is the ratio of new highs to new lows, okay? Well, wouldn't it make sense with the S&P 500 and the NASDAQ and the Dow at all-time highs that maybe there'd be more new highs than lows? And yet, there's the last time there was more new highs than lows, like back in the summer. So we have really lousy breadth. Like, pardon me, sir, you have bad breadth because you need participation. I hope that it's like, I sometimes use this analogy. Fabian and I are both into fitness. You can tell, look at the guy, he's buff. So Fabian and I talk about this, like, you can have a great set of kidneys, okay? But if everything else is failing, you're not going to live long, all right? Even though you have the best kidneys in the hospital that day. So this is the problem with the patient, is that it's got one good engine, and that's called the Mag 7, maybe 10 stocks, really. And then the rest of them are kind of, And that chart shows you. That's not a lie. That's just what's happening, right? Okay, so we've talked about breadth. Now let's talk about risk premiums. There's a number of ways we can look at risk premiums. Remember, I'm just showing you a few things here. Read my blogs, watch my videos, mostly my blogs because I go into better depth on them. Okay, so what's called the yield curve spread, the yield spread. What that is you take long-term bonds, like 30-year bonds. You can read on the left side, 30-year treasury bonds, the yield compared to 2-year bonds. Let's think about something. If you guys are buying a 30-year bond, wouldn't you, for that commitment, for that 30-year commitment, wouldn't you want more yield? Right? Okay. So if you are really worried about the future, you'd want a lot more yield than a 2-year bond, right? That's what's happening. The spread. Now, here's what's interesting is that spread is growing over time. That means the bond market, who's smarter, bond market or stock market? Bond market, every time, okay? World leaders, countries trade country bonds. What IBM's doing today is of no consequence to world governments. So that's important, that this spread is climbing. Meanwhile, this red boy is the VIX. Some of you guys know what the VIX is, right? Volatility index is the premium, the total premium, time and risk built into options. When the premium goes very low, it means that people are paying, are buying, the writers are building in less premium because everybody thinks nothing bad's going to happen. When you least expect it, right? So I'm going to take a closer look, but I just want to show you that the last time the bond inversions looked like that on such a great angle was 2001 and 2008. What happened in 2001 and 2008? Now, I'm not saying that's going to happen again because remember, we don't actually know. All right? We don't actually know. But I'm just looking at, this is the risk. By the way, I'm going to go into some positive stuff too because you have to balance it out. But I just want to show you that's the environment we're in. Let's take a look at the VIX closer. This is just over the past year, but take a look. Every time the VIX goes down to around 14 or 15, it goes up. I bought some VIX ETF in one of our accounts a couple weeks ago. Why? Because the odds are it'll bounce off of 15, and that's where roughly it is. It's just a good hedge. I don't think I'm taking a lot of risk because if it goes, like VIX is risky by itself, but at this level, if it breaks, I'll sell. Stop losses, all that stuff. You don't have to hang on and hope. If it doesn't work out, I'm out, right? But I think that, we're all about patterns in technical analysis, and that there is a pattern, okay? So I think that the VIX is telling us that people are complacent. Let's look at some more complacency. Here's a chart going back to what? 2014. Look at, this is margin balances, like margin accounts. Highest since 2014. So that might tell you in the past decade or so, you know, people have been pretty risk orientated, right? They're margining themselves to the hilt because they know NVIDIA is going up, right? And they know it until it doesn't, right? So the market has been driven partially by just people leveraging themselves. Okay, next thing. I've written a book on, and I use the title Smart Money, Dumb Money. I call my video Smart Money, Dumb Money. What Smart Money, Dumb Money is looking at groups of investors. Now, I'm not going to offend anybody here, but I'm just going to tell you the truth, okay? It's like you sit down and say, you know, you've got a problem. So we have a problem, and that is that we're retail. Well, I'm actually kind of in the smart money, but not fully. Like the real smart money is the Warren Buffett's and teachers' pension plan. I'm only semi-smart. So these people, the commercial hedgers, the ones that say Barrick hedges gold when they feel gold might have a downside. They're not hedging much right now, you might understand. So when smart money as a group is bullish on the market, that's a good thing. And usually right at inflection points, when smart money is excited, dumb money is terrified because that's at market bottoms, vice versa. So what do we have right now is the ratio of smart to dumb has been hanging out around here, okay? Now, this is not like immediately something happens, but typically when the ratio hangs out there for too long, the market eventually does something, okay? So it's not that day and just because it's right there at the moment. It's an overall, we look at what they're doing and are they buying, like are the buying calls, are they smart money, you know, buying into the market? Are the dumb money, and is the dumb money selling or vice versa? In this case, smart money's kind of cautious on the market, hedging and whatnot, and dumb money's piling in. And in fact, they're piling in with leverage, as we just saw. If that doesn't worry you, but wait, there's more. So we looked at, those are a few risk factors and where sentiment is, and I'm a major contrarian. I just, whenever I see a crowd doing something, I gotta move away. So seasonality is not something to set your watch by or set your trades by, but it is a tendency, and it's just one more factor. So seasonality over the summer, you guys might know, can be flat. You can see it on my chart there. It's like basically from July to around October. It's often choppy, okay? Doesn't mean it always is. But the real excitement of seasonality occurs in September of all months. This is kind of where we are right now. What is it, like the 13th or 14th or something? Yeah, 13th today. So, you know, in fact, September can kind of deke you out and go up a little bit, but the worst part is in that last couple of weeks, okay? So again, I'm not saying it's going to happen. I'm just saying this is what happens often. So here's the tendency. So here we got 1920 to 24, so we got over 100 years. That's probably enough data to say it's reasonable. And number of times up versus down, percent times up versus down. You can see there is a skew towards September's being lousy, right? And this is for the whole month, not just the last 2 weeks. Take a look at this. This ratio is the one that impresses me the most. So yes, there are positive Septembers. The best one ever was 16%. The worst one ever was 29. That's a double your risk. You know, if it's like going to the casino, you've got twice as much to lose, right? All things being equal. I mean, seasonality is seasonality. But I'm just pointing that out. That's something that, again, put it in your cranial vault. So all that, now we're going to talk about the technical stuff, because that's just kind of the risk setup. So the technicals, which is what I do best, are telling us a couple things. Number one, if we look at the stock market, as people that are trading on the stock market, buying stocks, trying to make money, there's two things from a technical perspective we can look at, okay? One is the risk factors like we just looked at, including some fundamentals. The other is trend, full stop, trend, okay? So the trend is your friend until it ends, as they say, so the trend is up. Anybody have any questions about that? It's going up. So you can't argue with an up tape too much, okay? I'm arguing with it a little bit because I see so much risk on the other side, because the other part is, beyond trend, it's risk, okay? So the risk is crummy, and the trend is good, pretty good. But with that in mind, I'm holding a bit of cash. And I'll underperform. I'm 20% cash. I will underperform as long as that keeps going up like that. But with the risk, I just feel more comfortable keeping some cash, okay? And you can disagree with me all you want, doesn't matter, because nobody's right until we know, right? So I don't argue over who's right, who's wrong. It's just our system says we must raise cash if we see what we've just seen. A couple things I'll point out is that one of the things I talk about in my books and on my course and all that stuff is that if a market, not a stock index is more than 10% over its 200-day moving average, I call that starting to get overbought. And both the TSX and the S&P are both in that zone now, okay? So we have one condition of being overbought. Money flow momentum. This is MFI, money flow momentum. Market made new high, peak, it's heading down. Divergence, right? Just like we saw with the Dow and the alligators and all that. This is the MACD indicator. You can't see it on the two lines, but you can see the histogram, which is the measurement between the two, is falling, okay? Divergence, okay? Those things can often, but not always, lead into a correction. Final RSI is not there, but it's up there. It's not diverging. So just got a couple things plus this that's telling me that the market's overbought. It can get more overbought. Go up another 10%, I don't know. But again, to me, the risk is high. And yet, I'd be a fool to stay totally out, wouldn't I? I mean, you have to sort of balance it, right? So this is the TSX. Now, you want to talk parabolic. Like, you guys know what the word parabolic means, right? Like, you know, don't take a picture and say, oh, it's me saluting Hitler or something. That's what happened to Elon Musk, went like that, and he got accused of that. It's like, no, I'm not a Hitler guy. It's way above the 200-day, okay? Look at that. It's like mega overbought. MACD is kind of flat, but RSI is way overbought. You know, that's an overbought market. Why? Because gold's gone ballistic and the banks haven't done too bad either, and that's the two big components, right? Metals, oil, and banks, right? So I'm just saying that I don't think there's any protection in the TSX if markets start to fall because it's overbought, even though I like gold. We own a lot of it, gold and silver. We were on gold and silver about almost 2 years ago before it became the hot item. So just to summarize, reasons for caution, the markets are expensive. The premium risk premium you saw in the bonds, you saw in the low VIX is high, and there's other factors I could show you, but you need 2 hours. The VIX is low, breadth is poor. You saw that. I mean, the New York Stock Exchange, that was just like plain as day. The market's overbought. We just looked at it, and seasonality can be iffy. All right. So with all that aside, how much time do I have? What time is it? 4:50. When do I have to stop talking? 10 after. Okay. Well, then I'll talk slow. So there's kind of three things that we've been focusing on. We have held quite a bit of global exposure at Value Trend. We are holding, you guys follow my blog and stuff, you know I'm big on hard assets. I mean, I got lots of gold and silver, but I've been buying the metals. I've been buying nat gas, which has not been a great trade yet, but I don't care because I think it's going to be, okay? So we got a lot of stuff you can get your hands on, okay? Because I won't go into it, read my blogs, because there's reasoning. There's AI, robotics, all this stuff. This stuff is all going to tie into that over time, all right? So we've been holding hard assets. We've been going global. And the final thing is we're holding 20% cash right now, okay? We're 20% cash. You could argue with me. What are you holding 20% cash? The market's going up because of the risk, okay? But what I'm saying is that when the markets, if the markets, and they may never do what I suppose they might do, is pull back some, then I want some cash. And I'm going to add beta. I'm going to add some juice to the portfolio. Right now, we're pretty defensive. So let's talk about thinking global. I'm just going to rip through a few charts. These are one-year charts. We have emerging markets. We don't have that ETF, but I'm just showing you what the chart looks like. It broke out, looks good. The VGK is Europe, okay? Europe is a big place, right? It's many countries. I would pick it apart a little bit, but the European markets have been doing well. Japan, nice move recently. And here's one that you haven't thought of. So you probably already knew about these three. This is one that I haven't bought yet, but I'm really interested, is the Central East Euro, meaning Poland and Eastern Europe, okay? Poland in particular is a very interesting country right now, okay? So they have very good fundamentals, the chart's kind of setting up. So everybody's on board on emerging markets. Emerging markets aren't even emerging anymore. They're already, look at China, you want to call that emerging markets? Like it's a, you know, what is it? Second biggest or third biggest economy. So like that's not an emerging market. So, and that's like a third of that emerging markets index. So this is an emerging candidate for sure. Like that whole region, that's an ETF that covers them all. But what I would do is look at the individual countries. And I was looking at Poland recently. So just think outside of having to buy North American stocks and NVIDIA. You know, you got to think of, because eventually the party ends. Okay, hard assets, stuff you can get your hands on. I've divided this up so that these are kind of, so here's materials, which is like chemicals and whatnot, and then this is the metals, okay? I'm into metals, they're just starting to move. I think there's a particularly, copper got spanked badly a while ago, but it's just bouncing off of the support level. It's kind of interesting. But I bought aluminum, and it's been just breaking out recently. So we like the metals, again, with that bigger picture in mind. Energy, I hate oil. I've made that very clear on all my blogs and videos, but I really like nat gas. Now, nat gas has been a choppy pattern. So if you look at a gas chart, you're going to, why do you like that? Because it hasn't been going down against oil, and I think there's a fundamental reason that it will eventually break out. Meantime, if you own producers, they often pay dividends. So gas in particular, uranium, we've been on uranium before it became the cool thing to do. We've held uranium for quite some time. And this is, what do you call it, rare metals. Okay, this is just a rare metals ETF. I'm not endorsing any of these, I'm just saying these are just ETFs that represent them, but you can sort of see what's happened. Boom, okay? Gold. Is there one person in this room that isn't aware of what gold's done? Somebody at the back. It's going up. And silver. Now, again, if you follow my videos and stuff, I was very early on silver because I started telling people to start selling some of your gold and buy silver. Because silver was a better case. It had, see the lag sort of, like, you know, by February, you can see that, but it took like several more months before it really broke out. Silver is now really doing some moving. So we think, we still like silver a little more than gold, okay? In fact, we sold some gold the other day. Not a lot, but we sold a little bit, okay? Okay, so final chart. So markets, if they fall, like, so there's no predictions here. As I said, I'm holding 20% cash, but I'm still 80% exposed. So if I was that bearish, I've gone as much as 50%, you know, out, but I'm nowhere near that because you don't argue with the chart. So if it does decide to decline, there's a couple of spots that I think it could pull back to. There's not a prediction here. So I'm not saying it is going here. I'm not going to say that. I'm going to say this is what could happen if all that risk stuff comes to play out on the pricing. 62 to 63 is an old resistance level. That becomes support, okay? And it kind of did. It's around the 50-day moving average, just below, okay? And if that fails, then the 200-day. Always pay attention to the 200-day, okay? And it doesn't, people say, well, what's so special about these moving averages? It doesn't matter. It's because other people think it matters. And therefore, it becomes a self-fulfilling prophecy and it bounces off of the 200. And I'm not kidding you. That's really why I watch moving averages. It's not because I think there's anything special about moving averages. It's because other people watch them and I know what they're going to do. So it is awful, you know. But, you know, you got to think how are other people thinking or not thinking. Bob Proctor once said, most people think they think, only a few people think, most people think they think, and the majority of people would rather die than think. I think that was his quote. But okay. So these are some of the things that I do. My blog, you can go to valuetrend.ca. You can sign up. We don't spam you. I'm in this information point of my life. I've made my money. I have the portfolio. I don't care. So I just want to pass on what I got. I do videos, same idea. You'll never see a commercial on my videos. Online technical analysis course I'm going to talk about in a minute. I've written a few books. I sell them cheap every year here. We even have like a newsletter. And of course, we're in the portfolio management business. Sometimes I forget. So for the people that want help in their portfolio, that's what we do, okay? We take an absolute rock bond minimum of $500,000. A typical client is anywhere from 1 to 20 million, but it's kind of 1 to 5 is our sweet spot. So anyways, our online course. Once in a while I do a 30% discount, and it's not often. For those of you who watch my videos, you won't have seen a discount before in a while. So I do a 30% discount, so it brings it down to about $278. It's TA30 at the bottom. And you just go online, go to Value Trend, you scroll down, and you'll see the thing for the online course, and you just type in TA30, and you get the discount. You have to do it by the 30th, okay? If you phone us on the 1st, we won't extend it. So now I'm going to just open it up to questions. We've covered a lot, so sorry. Oh yeah, sure. Okay, so effectively, it's like my life's work in a course. It's 7 hours long, broken up into like 15-minute modules with little quizzes at the end. It's online. You can take it a million times if you want. There's no limit to how many times you take it. And so long as I'm in the business, you'll have access to it. So it basically starts off with the basics of technical analysis. It goes into things like money management, which I think is the most valuable part of it, which is not money management as in save $100 a month for your RSP, not that stuff. I'm hoping you're past that. My people that read my stuff are. It's, how do I allocate? How do I leg in? How do I leg out? How do I use a stop loss, properly? Stop losses will kill you if you put them in physically. So I tell you how to do it properly. How do I sell? Which is way harder than buying. So those are the things I talk about. I touch on other stuff like Elliott wave and what the Fed, why the Fed matters, and how you play against all that stuff. So it's a fairly in-depth course. So yes.
I was wondering if you still hold SPPT, the spot physical platinum palladium.
Yeah, we do, and it's been. It is.
Lagged a bit, right? Should expect that to catch up?
Yeah, we leg in, and it hasn't broken its old lows or anything, but it's not done anything. So we won't buy any more. So we do legs, and that's one of the things I talk about in the course, is you do 2% and you wait. And if it keeps going in the direction you like, you buy another 2%. And if it pulls back, but you're still within a trend, you buy another 2%. So that's how we do things. So I bought a leg in our aggressive platform. It is not in our conservative platform. We do stuff like, for instance, the VIX ETF I mentioned, that I bought a position in a VIX ETF. That's in our aggressive. It's not in our conservative yet. We may buy it in our conservative, but at this point, it's in our aggressive. So, okay. So, ma'am, you were.
Hi. So for nat gas, you said that you're a huge fan.
Yeah, fundamentally.
Canadian and U.S. companies, and would you be able to give a couple of examples of your favorite based on fundamentals?
Sure. So you want to read. I just wrote a blog recently. I'd say go to my blogs and type in pipelines, and there was one very recently. Okay. So I didn't name specific stocks, but the Canadian. I mean, if you look at the charts of the ETF they put up for producers in the gas producers in the U.S. versus the Canadian, I kind of put them both up, and the producers in the U.S. don't look anywhere near as good as the Canadian. So I have real hope for the Canadian. I mean, I won't get political here, but we need the pipelines built, and it's our only hope with what's going on. So I think it's like a necessity, and it will happen because of that, and therefore, what do I know, right? But because of that, we'll probably see Canadian pipelines do well. It may take a year or two, but I mean, it could be just very, very good, because it's a perfect storm. We've got Europe needs natural gas, Mexico needs natural gas. Canadians need natural gas. We all need. It's an AI. Why do you think Kevin O'Leary put up an AI center in Alberta? Why didn't he put it in New Brunswick or something? Yeah. He's putting up an AI center because the best source of power for him is nat gas. He's not going to sit around and wait for nuclear reactors to be built. So, and it's right there. So there's a real argument for a 2 to 3 year argument for gas. And in fact, they say out to 2030 that the demand for nat gas is going to go exponential. So I don't know what's going to happen in the next 12 months, as long as it doesn't break huge levels of technical support. We're in the trade. And we're in the producers, and so, I won't give away, but, we have Pembina is just broke out. We like that. Yeah, so just look at them all. They're all good. Buy them all. I don't know. Yes, sir.
Yeah, so you mentioned that you sold some of the gold.
Yes.
Let's assume that you don't have any gold position right now. Would you buy gold at this price?
Man, well, actually, no. And here's proof to the pudding. We get new clients all the time. And so we just took in, some pretty substantial chunks of money from a couple of clients. And I just took it in, like 3 weeks ago. And I didn't buy them the gold. I bought them everything else in the portfolio because I loved everything. And I'm like, I want to wait. Now, of course, gold went up some more. but I just am not comfortable right now with gold. But, talk to me 5% lower, and I might, or maybe 10. But I don't think it'll go 10%. I just think it's due a correction. I can't tell you how deep. I just don't buy overbought stuff. I'm not comfortable with it. But I hold it. I just reduced it, and what did we buy? We actually bought some more nat gas. Okay, so I'll just this guy and then this guy.
Do you have any opinion around the American debt, all of this noise around
Oh, yeah.
stablecoins and bonds?
Wow, that's 3 things, right? Okay, so American debt is not good, just like Canadian debt has shown hurting our economy, right, over the past number of years. So U.S. debt is going to hurt them too, right? Stable coins and Bitcoin and all that, obviously, and particularly with Bitcoin, there's been some strength. Like, it was sort of a fad, not fad, but it was kind of like for 30-year-olds who still live at home with their moms and dads trading Bitcoin online, and now it's like serious traders, serious people are trading Bitcoin. I do see that. It's a serious security now. So I think there's it could be like a similar to gold and stuff as a currency hedge. So yeah, I haven't really been involved because our portfolio is largely conservative, but we are actually interested in that space now. I just attempted to do a trade on it the other day, didn't get my price. But, whatever the case, yeah, I think Bitcoin and all that probably has a future from what I'm seeing. It's all about volume, right? And it's about number of traders that are involved. So if 3 people are involved under an apple tree, it's a low volume market. But if a wider audience starts trading it, including more sophisticated traders, then it becomes a real thing, And I think that may be happening. There you go. Okay. Sorry, you had a question. Yeah.
Did you buy the gold or the gold miners or both?
I bought miners. Yeah, I prefer to go with the miners because Craig and I have traded commodities too many times, and they just, honestly, it's like we're cursed. So it's like if you hear me buying the commodity, run, because I can buy the producers and works every time, because you've got a bit of time if you're wrong in the trade in the near term, right? But sometimes the commodities don't move the same way. They should, but there's a lag, and I just like the producers, so that's